Slippage is something you have likely experienced from trading a range of financial assets like stocks or cryptocurrencies. Slippage is something that frequently occurs, especially when trading on the spot market. Before we explain what slippage is, how it works, and how to mitigate it, we want to say thanks for coming back to our educational channel where we explain complex topics simply, through animations. Let's get back to the video. So, what exactly is slippage? Slippage is the difference in price you intended to pay and the price you actually paid for a financial instrument like stocks or cryptocurrencies. Slippage typically occurs when purchasing or selling in the spot market, which means you were trading at market prices. Slippage can occur for a variety of reasons like market volatility, liquidity issues, and more, which we will explain later in the video. Let's look at an example of slippage. An example of slippage occurring in the cryptocurrency market is if you decided to purchase a full Ethereum coin for $2,000 but end up paying $2,050. In this example, there was a negative slippage of 2.5%. That's right, there is such a thing as negative and positive slippage, and this can occur with both the buying and selling of assets. Let's break this down. Positive slippage occurs when you buy an asset at a lower price than intended. This means you pay less than the intended price. Negative slippage occurs when you buy an asset at a higher price than intended. This means you pay more than intended. An example of positive slippage occurring is when you intend to purchase one Bitcoin for $60,000 but the price falls and you end up purchasing one Bitcoin for $59,500. This means you received the asset at a price lower than what you were prepared to pay. This is a win. An example of negative slippage occurring is when you intend to purchase one Bitcoin for $60,000 but the price rises and you end up purchasing one Bitcoin for $60,500. This means you received the asset at a price higher than what you were prepared to pay. This is a loss. Positive and negative slippage can also occur when selling an asset. Positive slippage, when selling an asset, means the trade executes at a higher or better price than intended. Let's say you wanted to sell one Bitcoin for $60,000 but end up receiving $61,000. This means you gained more for your one Bitcoin than expected. Negative slippage, when selling an asset, works the other way around. For example, when you intend to sell one Bitcoin for $60,000 but ended up selling at $59,000. This means you, as the seller, received less for your one Bitcoin than expected. $1,000 slippage is quite a bit, however not totally uncommon, and is a hypothetical example that our team used to portray the effects of slippage. However, there are two easy ways you can mitigate the effects of slippage. The first is by setting a slippage tolerance. Slippage tolerance is a feature that most brokerages or exchanges offer. It allows you to set a percentage on the maximum acceptable difference between the intended trade price and actual trade price. If the asset's price falls above or below the trader's slippage tolerance, the trade won't execute. Slippage can be set on a range of different crypto exchanges, including decentralized ones. Another viable option to mitigate slippage is by using limit orders. Limit orders allow you to set a minimum price you are willing to sell the asset for and the maximum price you're willing to pay for the asset. This option is available on the vast majority of exchanges. Slippage seems like a hassle. Is it possible for traders to avoid it? Traders, especially those trading within the crypto market, have become accustomed to the volatility of the overall market, and some have realized it's something you have to deal with, and it's something that occurs for a variety of reasons. These reasons include market volatility, or a large change in price, which make it challenging for brokers to execute trades at the desired price. A lack of liquidity, or the lack of willing buyers and sellers. This may cause trades to execute at prices different than what was desired. Other factors include order size, latency, or delays due to technical issues, and more. In conclusion, slippage is an aspect that traders should be aware about, and one that traders can try to mitigate via slippage tolerance and limit orders. If you found this video informative, please leave a like and hit subscribe to reward our team for our hard work. Thanks for learning with us, and we will see you in the next one.